Good afternoon, and thank you for joining us for today's CCI Golden Horseshoe Chapter Condo Talk webinar. My name is Maria Durden. I'm a partner at Simpson Weigle Law and the chair of the Condo Practice Group. I'm also currently the president of the Golden Horseshoe Chapter and the co-chair of the Education Committee. Condo Talk was created to provide free, short, informative, and practical solution-based webinars to condo owners, directors, managers, and those servicing the condo industry. Today's Condo Talk, Riding the Rising Insurance Wave, Part 2, will be discussing the role of insurance broker, considerations to balance the coverage against the premium paid, what goes into determining a policy premium, how to manage policy as to the best in class, ways to minimize risk, and a discussion of real-life examples of condo insurance cases and decisions. This is an extremely hot topic. Thank you so much for sending in your questions. And we're going to jump right in. So first, thank you to our sponsors. First, we have Normac Insurance Appraisal Experts, Condo, Atrans Council Insurance Brokers, part of Arthur J. Gallagher Canada Limited, Ely Associates, and Common Ground Condo Law. Thank you so much for sponsoring this webinar. We also have the same speakers that we did have at part 1. We have Mark Shedden, he's the CEO of Atrans Council Insurance Brokers. Richard Elia is a condo lawyer with Elia Associates, and Michelle Joy is a general license manager and registered condo manager and a director of condo management at Wilson Blanchard. Welcome back, everyone. We have a lot to cover, and a lot of the presentations will also answer the questions which you raised at our Part 1 seminar or webinar, but we were not able to get to. So let's jump right in. Mark?
And I think it's officially 12 o'clock now, so I'll say good afternoon to everybody. It was very interesting to see some of the feedback we got from part 1, and I hope everybody respects in this kind of format that it's virtually impossible to get down to the nitty-gritty as to why things work the way they do, especially in the insurance business. Some days I wonder why they work the way they do. But in any event, with respect to the standard unit definition and what have you, it was interesting to see some of the feedback and thoughts on that. And I just unfortunately don't think we have the time on these type of webinars to explain that whole issue. So I hope at some other time there'll be a forum where we can discuss those. But today what we wanted to do is, what I wanted to do based on a lot of the feedback that we got from part 1 was to talk about the role of the broker, considerations that the boards want to think about with respect to the balance of coverage versus premiums, and then what goes into really determining a policy premium, and what does generate that final big lump sum that you have to pay every year for the insurance coverage. And really, as I mentioned on the part 1, was the best way to manage your insurance policy is to be best in class, and talk a little bit about what it is to be best in class and how you're going to be able to obtain the best bang for your buck. So I want to talk a little bit about the role of the broker first. The role of the broker is to act on behalf of the customer. And in the case of a condominium corporation, the customer really is several. It is the unit owners, it's the board of directors, it's the property manager. And it's our role really as a broker to stay current with the market. You know, a lot of people think that insurance is something that's shopped every year at renewal time. It really isn't. It's an ongoing process. A broker that specializes in the field of condominiums is constantly looking at new markets, new avenues, price runs, all kinds of different things that are ongoing daily. I mean, companies are changing rates and their preference for certain classes of business daily. So it's important that a broker keep very on top of that. The broker works for the customer, doesn't work for the company. Now, in certain cases, you may have come across agents who work directly for an insurance company. That's typical of the likes of State Farm, Allstate, Desjardins, some direct writers. You hear about them in the US and you hear about them in Canada. That is where an agent represents that one company only, and that's what they sell. They sell that company. A broker doesn't do that. A broker has access to multiple markets. If I were to work for a company or insurance company, I would have to work for over 350 to 400 different companies because that's who we would have access to. Sadly, Not all those companies write condominium insurance. As a matter of fact, very few do, because it is not really a preferred class of business right now in the industry. Not specific to condominiums, but generally just the whole realty itself is a class that's under huge scrutiny right now. So the broker's job is really to obtain the best coverage at a fair price. It's not always going to be the best price, because people tend to think that the best coverage you can get is what is the best prices. Well, the reality of the animal is that companies get into the class of business, and very often if there's a shakeup of some kind, they'll get out of the business. Well, if you're in a position where it's just like your auto insurance, if you have an accident or you have a claim of some kind, and the company that you're insured with gets out of the business, now you've got to remarket yourself as a new risk. And when you're marketing yourself as a new risk with claims attached to your experience, it's very, very difficult to get terms until you earn your way back to being best in class. So the broker's job is not only to find you the proper coverage first and foremost at a fair premium, it's also their role to make sure that you're advised properly on the markets that are securing the insurance coverage for your specific condominium corporation. So I'm just throwing that out to you to be very careful that there's more elements to consider. Considerations really of what the best coverages are, or sorry, the balance of coverage and premiums. Well, they're basically 6 coverages. There's property insurance, there's general liability insurance, which provides legal liability for or liability stemming from the common elements. Boiler machinery, which is your mechanical and electrical coverage. You have human rights coverage. You have fidelity coverage, or what they sometimes call a bond, which is basically protecting the money of the corporation from the fraudulent acts of the employees. And for the purposes of a condominium, the board of directors are considered employees with respect to the bond. And of course, there's some other extensions and policies, legal expense, just name one. There's all kinds of things that insurance companies will throw in as enhancements to the policy to just provide a little better solution in the event of a claim situation. But the reality of the animal is the bulk of your premium revolves around property insurance. Now, in a smaller corporation where the property value isn't so prevalent, the liability plays a bigger issue. Liability insurance, you can run into some minimum premiums, and that will be a bigger component of what makes up the premium. All these coverages do have a premium attachment to it, but I've often seen boards come to me and say, well, what if we reduce this? You could find that you're actually nickel and diming your policy, where saving really nothing by concentrating on all these extension coverages. The bulk of the premium is going to be in your property insurance. It's a rate per $100 of value, and of course that's what varies between companies. Okay, so how do you become really best in class? That's really the important thing. How is it you're going to make sure that you are obtaining fair price for the best coverage available? And one of the ways you can do that is through deductibles. I mean, deductibles are a great tool. A lot of people don't realize a deductible is not the penalty. The deductible is a great management tool that the corporation can use, one, to make sure that unit owners are making an effort to maintain their units and understand they have some accountability in the event of a loss. So often people say, well, we don't want a high deductible. I've often encouraged some of our clients to take a higher deductible. Especially where you've got a lot of frequency, or especially where you have maybe unit owners that just don't care as much as they need to, and you're having a difficult time making unit owners care as much as they should. So by increasing the deductible and putting that onus on them to secure that coverage for that deductible under their policy, you really are managing the corporation's policy to be best in class. Sorry. The other thing is making sure, and we talked about this in part 1, there are 2 key elements: the deductible bylaw, Making sure the deductible bylaw is very clear and making sure unit owners understand that obligation in the event of a loss through their act or omission that causes damage to corporation property. Make sure they're fully aware, and I know we talked about that under the communication thing. The other bylaw we want to pass, of course, is the standard unit bylaw. And while we can argue that till the cows come home, the reality is there should be a standard unit bylaw in place, if to do nothing more than to provide clarity to owners so they clearly understand what their obligations are under a unit policy. The other thing that's very, very important is most declarations call for an appraisal every 3 years. But if you don't keep current with your appraisals, very often you're penalizing yourself, because insurance companies put an inflationary factor so if you take that inflationary value and you compound it over 3-4 years, things start to get distorted, because usually that amount increase in inflation that the insurance companies apply is greater than the true inflationary factor. So if you compound that over 3 or 4 years, your appraisal number can get distorted. And what that means now is that your property value will be overstated, and therefore what you end up with is you're paying more premium than you really should be. And finally, the most important thing is claims management. Everybody needs to remember that claims, no different than your auto insurance or your home insurance, are going to trigger loss cost. And that's what's called underwriting by experience. So corporations need to be very conscious of claims activity. Just because you have a claim or a situation that could be a claim under your file, you don't necessarily want to go ahead and report that. You don't necessarily want to trigger an actual claim under the policy. And that's going back to where a broker comes in. Pick up the phone, call your broker, discuss with your broker what the impact of that claim might be. Just because you call your broker on a file doesn't constitute a claim under the file. Normally, what the broker will do is say, look, your claims activity has been thus. To put this claim through is either going to, and this is usually based on experience, is either going to increase your deductible or it's going to increase your premium. So be very, very careful. You can work with your broker on that. Finally, I don't want to, I know I'm limited to the time here, but I just wanted to bring up an example. Going back to our first presentation, when we talked about standard unit bylaw, we have a real life example up in Richmond Hill. I'm sure most of you are aware of a very serious fire that was suffered up there in Richmond Hill a few weeks ago, and what it was some stacked townhouses. Approximately 18 units were affected. Of course, we happen to be the broker on that particular item, unfortunately, but that's what we're here for. And what's interesting about this case is, while all 18 units were affected, and it looks like they are going to take the building right back down to the foundation and rebuild it, from what I understand through the claims people, the interesting thing about this is that there were 3 owners that did not have insurance, sadly. Interesting enough, too, it was a greater than average rental property. There were 4 tenants in there that did not have insurance. Now, I just want to bring this up because this is an example of a building that did not have a standard unit bylaw. So that it's an older building, and therefore we go back to that which was called for by the builder when the building was built up to builder spec. If those units had passed a standard bylaw that was bare bones, what would those 3 people that had no insurance do? What would the mortgage companies that they had arranged a mortgage with do? What are they going to end up with? They're going to end up with 3 shells, which, if they don't have any other unit, they don't have any unit insurance, unless they have the money or the resources to do it themselves. The other 15 people that live in that building will be living beside, above, below, or what have you, a shell. And that is really not, in my view, what we want to create after a loss in a condominium community. So I just wanted to bring your attention to that. The tenants packages, obviously the people that were tenants that didn't have insurance, they're going to lose their contents. They're going to lose their ability to provide any additional costs in relocating. So that's going to be problematic for them. So I just wanted to bring that up as an example of a true life case that we see very often. So I think my time is up, and I will pass it on over to Maria.
Thanks, Mark. Yeah, that's quite the story with respect to the loss and there not being a standard unit bylaw. That was one of my questions, so you answered that. But I have one other question, perhaps some clarification for the viewers. You had mentioned that deductibles, sometimes you recommended being a higher deductible for certain corporations. It's used more of a management tool versus a punishment. Unfortunately, most owners see it that way. How is the deductible amount determined? Is it determined with the more claims you submit? Is it based on location? Is it based on the type of condo? Is it a multifactorial approach? How does the board decide what they should have as a deductible, and how much say do they actually have in what the deductible should be?
Well, you always have the choice of raising a deductible. No insurance company is ever going to argue with you in raising a deductible. And of course, you've got to measure the cost advantage of that versus the higher deductible. Is there going to be a premium savings of some kind, or do you just want to do it to better manage the frequency of claims in the unit? Usually deductibles are triggered first and foremost by the insurance company that underwrites the risk. Different companies have different minimums, and then of course they're going to take into consideration your claims experience. For those of you that have had 3 or 4 water claims in a couple of years, know exactly what happens to your water deductible. So it'll be triggered by loss experience. What I was trying to do as far as talk about managing your file is don't always take that deductible as being the only option. You may want to go higher. Again, you may want to trigger a higher deductible for better management of the corporation. So there's 2 ways a deductible is triggered, one by the insurance company and one by you, the client. It's trying to find that perfect balance of what the suitable deductible for the individual corporation is. But usually it's based on experience. Sometimes in certain territories, for those of people out west, if there's anyone on this call from out west, you know that we don't really suffer hail in Ontario like they do out west. We don't have the climatic issues that they face out there. So their deductibles applicable to those various types of perils are going to be totally different than that in Ontario. So yeah, location, type of building, claims experience, all go into a deductible determination.
And owners should, it would be highly recommended once the corporation has established its insurance policy, deductible amount, provide that information to their insurance company, so perhaps they can find a rider or something which would pay for the cost of any deductible payments, which saves, I think, all the parties involved a lot of headache.
Absolutely. There's no, you don't want to find out as a unit owner that you've only got $25,000 of deductible coverage under your unit owner's policy at the time of a loss, when in fact you've got $100,000 deductible.
Yeah, and that you could have possibly insured for a nominal amount, but you didn't put your mind to it because unfortunately insurance deductibles are those things until you actually have to pay it, you don't appreciate it. So we want to do more of a proactive approach, and maybe Michelle can talk about that later on, about how do you share that information with owners, insurance companies. But before we get to Michelle, we have Richard, who's going to kind of go into more of the legal aspect of insurance and dive deeper into his discussion from part 1. Richard?
Great, thank you. I'm going to start with going through I'm going to do some insurance mistakes. And this is the only slide I'm going to be referring to. The first has to do with loss recovery, and the fact that sometimes it seems that unit owners are being confused for the insurer. And I say this because we'll receive instructions from a client to say, register a lien against so-and-so. This has to do with damage following an insurable loss. And when we look into it, we'll find out that it's over and above the deductible amount. And when we ask about it, the answer back is, well, it's okay because we didn't make a claim. We're not relying on Section 105 Sub 2 of the Act, or 105 Sub 3 if there's a bylaw. We discussed this in Part 1. But rather, we're relying on the indemnity clause in the declaration. I really want to stress this is wrong. you can't do this, and it will come back to bite you. When it does bite you, it'll be too late because you can't then recover your lien rights. The condo has the option to put a claim on or not. That's up to the condo, but it doesn't change the fact that that we're talking about an insurable loss. So if the condo chooses not to put a claim in, that does not deny what would have been insurance coverage for the unit owner, because as you recall from day one, the condo's policy insures the corporation, all the unit owners, and all the mortgagees from time to time. They're all covered. So the condo can't act so as to vitiate any coverage that owner would otherwise happen or have. So if there is an insurable loss, and with very rare exception, and the exception would be something like arson, the maximum the condo can charge back to the unit owner is the lesser of the deductible or the actual repair costs. So that's the first error that I wanted to cover. The second one, not really an error, this is more like risk management. It has to do with the timing of registration. If you're recovering deductible and you have to register a lien to secure payment, the timing of that lien. And the law is, it hasn't changed. You've got a 3-month window to perfect. The lien arises automatically. It's a statutory lien. You've got to perfect it within 3 months. This was covered, 3 condo talks ago, something like that. Now, if we're talking regular common expenses, which might be $300 or $400 a month, we get to the end. We get to month 3, so we've got maybe $1,200 of common expenses outstanding. We register the lien, and then in month 4, we say, "Oops, we made a mistake." And no one's infallible. We like to think we're all perfect. We're not. And we find there's a mistake, so we have to re-lien that unit to correct the error. What's the risk? The risk is 1 month's common expenses are $400 in this example. But if we're talking deductible, on the low end these days is $5,000. More realistic might be $50,000 or more, depending on your claims history. So if we leave it till the 3rd month to lien, and in the 4th month we have one of these oops moments, we've got a real problem, because that is significant. It's not something you can just make up. So for managing that risk, don't wait till month 3. Do it in month 2 or even earlier. There's no minimum time to do it. The next mistake has to do with the wording that I'm finding in some of the bylaws. There's no case law on this, but I'm waiting for the first fight on this particular example. So section 105, we talked about this last day one. You can pass a bylaw to extend the circumstances for recovery as long as there's no act or omission on the part of the condo that contributed to the loss. And some bylaws out there are keeping the language of act or omission. Other bylaws are going towards strict liability. Strict liability is where we really don't care how it happened or what the involvement was. If the source was a particular unit, we're going to charge it back. Sort of like being stopped by the police because you have a tail light that's not lighting up anymore. The police don't really care what your excuse is, what your intention was. You're getting a ticket. So we got those two examples. But then I'm seeing some other bylaws which just say we're going to charge back the damaged unit. And think how this would play out. The condo sends a demand letter to the damaged unit, and the owner's saying, "But I didn't cause the water damage. I didn't have anything to do with it. The water came from the unit above because the bathtub overflowed. Why am I being charged back the deductible?" And I think there's something that goes to unreasonableness to that. There's no policy reason or good policy reason to charge someone that had absolutely no reason for that loss. Similar, and this wouldn't work, but a similar example would be if there was a common element roof leak that damaged the unit, you could not then charge back the deductible. So we're going to see how that went. I'm sure that'll end up being challenged at some point. The last point I want to make has to do with the difference between negligence, act or omission, and strict liability. And timing is perfect on this. A case came out not too long ago, Lozano, TSCC 1765. Fabulous decision. Really commend the condo's lawyer on this. I truly enjoyed reading this case. So again, we've got that range. And the range really goes from negligence to strict liability. For strict liability, I've already mentioned it. We don't care how it happened. If you're the source unit, you're going to be charged back. Negligence is at the other extreme, where we've got to show, the condo would have to show that the owner had a duty to do something. In this case, it could be duty to maintain a unit, that there was a breach of that duty. This is the hard thing. How do you show that that owner breached the duty to maintain the unit? And then there would be foreseeable losses that would flow from that breach. It's not an easy standard, and it invites a bit of conflict. Act of omission has long been held to be somewhere in between. And Lozano tells us where that might be. So the facts in Lozano are the great facts. Lozano moved in 2010. No renovations done to the unit, which would change the typical layout or finish. In one of the toilets, the float cracked in 2018 and sinks. You know, I don't know if any of you have opened toilets. Floats are rather general in nature, I guess. Mr. Lozano sees it as general. He probably went to Home Depot, picked up a new one, and replaced it. And the toilet's working again. Then the Lozanos go away for 6 months. I don't know the reason, not really relevant. The unit's vacant, but they do arrange to have a relative stop in every 2 weeks, minimum of every 2 weeks, to check in on the condition of the unit. Very, very responsible. And at some point, the toilet starts to leak. And, you know, again, they're checking every two weeks, so no big to do. But by the time it's noticed, the water's already damaged their unit and the unit below and the common elements on both levels. And the reason for it was a broken ball cock valve in the toilet itself, which caused the water to run constantly. So the question becomes, is there an act or omission? The condo had passed the bylaw. The bylaw kept those words, act or omission. So was there an act or omission on the part of the condo that would allow the condo to charge back the deductible? And we've just listened to Mark, so we know the accountability is very important, you know, to be able to do that where we can. The Lozano's position was very clear. They said the unit's always being carefully maintained. When the toilet developed, when the float cracked, it was repaired promptly. They didn't wait around. There was no disrepair. When they went away, they arranged for someone to look after the unit. You know, and then they point out the piece that broke. There's no possible way that they could have that this was foreseeable. The toilet functioned entirely properly when they left. They could not have foreseen this. There was no breach of their duty to maintain the unit. So they took it to a breach of duty. They were looking at negligence, really. And the court didn't agree with them. And what I really like about this case is the court looked at how the condo operates and the fact that in a condominium, there's a community behind it. It's not a single family home where you're responsible for everything as the unit owner. There's a community, so a greater level of responsibility. And the court looked at the fact that the proximity of one's neighbors, make it that actual omissions of an individual owner can have much more immediate and much more significant impact on those other residents, on those other neighbors. The court looked at the policy reasons behind sections 105 sub 2 and sub 3. Sub 2 has the general act or omission for damage to the unit. Sub 3 is you can expand that by bylaw, and said, why would they do this? And the policy reason behind it was to place the burden of paying the deductible on the person that caused the loss without considering whether there is negligence. All right, there's an intention to protect the community, all unit owners, against recurring repair costs, and to prevent those deductibles being covered under a common expense or as a common expense. When it's a general common expense, basically you're subsidizing potentially bad behavior. We don't want to do that. We want to recognize that policy reason for the deductible. And the court felt that Lozano's position, i.e. having to show negligence, that breach of that duty would impose to a great expense on the collective, and they didn't buy it. They looked at other case law. There was a case out of Alberta, for example, where they looked at a 3-year-old furnace that malfunctioned, causing a flood. And in that case, the court found that the unit owner's act or omission was in failing to have the furnace inspected after installation and regularly maintained. That was the act or omission. If they had done that, perhaps they could have prevented the malfunction. So in this case, the court is obviously looking, they're looking at that range between negligence and strict liability, and they're going over towards strict liability in this. The court looked at what Lozano had done and didn't do, and concluded that the failure of Lozano to basically retain a licensed plumber to fix that float was an omission, because the plumber may have noticed something more with respect to the toilet, may have noticed that deteriorating plastic ball cock valve. Don't know, but maybe. Also, the court looked at the fact that while Lozano had arranged for family to watch the unit, they didn't bother to shut off the water. That was a bit that was a secondary reason. The main one was assuming responsibility for that repair. So like the furnace case in Ottawa, the court considered if there was something more that could have been done to prevent the loss. In this case, had Lozano's retained the plumber, perhaps the plumber might have noticed the damaged ball cock. This wasn't done. This was the omission, and the deductible was properly concluded to be properly charged back. And how do I shut off the sharing feature? Here we go. And that's it.
Thank you, Richard. I suspect that although most legal counsel may be excited about this case, I think most people who are viewing this webinar today are thinking, my God, that's clear as mud. Okay, so they found that they may have or should have had someone come in and inspect it, but at what point are we reaching of that obligation to do maintenance within our units? So I wonder, here's a question, what if there was no damage ever occurring to the toilet, no repairs were ever completed, and it just failed? What if the ceiling around the toilet just failed? No repairs were done, no one did home repairs, no one's uncle went in and caulked anything, it just failed. Then what?
Well, my question back on these facts is, did they shut the water off?
Let's say they did.
You know, many condos, and I'm sure Michelle's going to speak to this, many condos have got policies in place which say when you go away, shut the water off, have somebody check your unit. If you do have to do repairs to a unit, have a licensed trade do them. And the reason for that is to manage risk, because the risk is not contained to the unit. The risk impacts the community. And what I really like about this, and I'm not sure if the tribunal is going to like me for saying this, but I like the fact that this case came out before the tribunal starts dealing with chargebacks. Because I think from a policy perspective, my worry was always having to prove act or omission and how much condos were going to have to spend of community money to create that accountability, to actually deal with a policy reason behind why deductible exists and why it needs to be able to pass it on to an owner. And my worry, or what I like about this case, is we now have some very direct guidance to the tribunal on how it should play out.
Mm-hmm. It's certainly interesting. I find insurance and deductibles to be one of those really gray areas. It is. I mean, as much as we do get direction from case law, especially this case that you just summarized, Richard, I don't think it's perfectly clear, unfortunately. And it shows the importance of, like you said, possibly having policies and procedures in place, which does confirm and make the corporation's position a lot more stronger. But there's a lot to do with management when it comes to insurance. I mean, not only do you have to set the corporation's insurance policies, Michelle as manager, but also perhaps helping owners communicate or giving them the tools to communicate what the corporation has so they secure it for their own units. How do you go about doing things like that?
Yeah, that's a great point. And again, I think my first presentation on this topic was heavily focused on communication. And again, that's what I'm going to be going back to, because as a manager and as a board, I think it's important to be the voice between the professionals and then the residents. So one thing I wanted to highlight, which Maria, you touched on, and I think kind of flows with what Mark and Richard talked about, is making sure that owners are aware of their responsibilities and making sure that they, you know, instead of just sending them an insurance certificate, making sure that they understand what that information actually means. So I put together just this is a notice that I've used with a couple other corporations. As a director in my office, I review a lot of stuff that other managers send out. And I often just see a very generic, please review the attached insurance certificate. It is important for you to read. An owner's going to look at that and probably toss it in the bin. Maybe they're going to read it, maybe they don't. So I'm for over communicating. So I just wanted to quickly share a sample of the type of information that would be helpful to communicate. Okay, so this is a generic important insurance policy information update to residents. You could also, I would also recommend that you consider a lot of the same wording and information when you send out an information certificate update for a change in your insurance deductibles. So I'm just going to quickly highlight it. So first paragraph essentially does an overview of the corporations required to obtain insurance coverage as per the Condo Act, what that includes. It makes a note that the extent of the corporation's insurance is to the standard unit. If you have a standard unit bylaw, reference the bylaw. You can also make a quick note that if owners don't have a copy of it, they can email management to obtain a copy for their review, because it is very important for them to know what's in that. And then you can do just a little verbiage on what the standard unit excludes. Excludes upgraded flooring, cabinetry, etc. Next paragraph is highlighting the information on your insurance certificate. So your policy runs, this is just generic fake information, January 1st to December 31st. Your policy number is 1, 2, 3, 4, 5, 6, 7. You're insured by company 1, 2, 3, sometimes 5. And then highlight the deductibles. So some insurance certificates, the deductibles are very clearly laid out. And I've seen others where I'm looking around the page trying to figure out what the deductible is for each, what the amount is for each respective deductible. So clearly lay it out for the owners, what the amount is, what the deductible is and what the amount is. If this is for a ICU, for change in deductibles, highlight what the insurance coverage is, the old deductible amount, and what it is increased to. So just add a third column to highlight the change in the deductible amount and when that change takes effect, which would be the policy renewal. Last paragraph is just a recommendation that owners review this coverage annually and share it with their insurance policy to make sure that they have coverage for the noted deductibles. And then also make a note that the owner could be liable for the chargeback up to the deductible amount. And again, this is going to be based on the wording in your declaration or a bylaw, what you can and can't charge back. So I just wanted to highlight that quickly. Don't just say, here's an insurance certificate, please review it. It's very important. Extract that information, let the owners know what they need to do with it and clearly lay it out for them, and hope that everybody reads the notice that you send out, because we also know that not everybody reads what comes to them, unfortunately. But I think that's a good starting point, so I want to share that with everyone. And then next, I just want to highlight from the management perspective, how you can mitigate risk with regards to insurance claims. So again, this is kind of touched on a little bit, but essentially you can break it down into 3 categories: fire, water, and liability. So in order to mitigate risk with regards to fire, in a high-rise building, doing your weekly, your monthly, and your annual fire inspections, ensuring you address any noted deficiencies in a timely manner. Make sure your on-site staff, your board, management, residents know what to do in the event of a fire. Annually, send out a reminder to residents. This is what you do should the fire alarm go off. This is what you need to do if you can't leave your unit. Hold fire drills. In many regions, quarterly fire drills are mandatory from the fire department under fire code. So hold fire drills so residents know what to do in the event of a fire. Water. This is probably the one we see the most of in buildings. It's the most common as a manager that I deal with. This has kind of been touched on a little bit already, but check your valves. So Owners should know where the shutoff valves are located in their suite. I've seen them in very strange hidden places, but owners should be aware of where they are. As noted, when you go away, make sure there's a policy for residents who are going to be out of the unit for a while. Shut off the water, have someone check on the unit. But also, residents should be exercising the valves regularly. All too often, they go to shut off their water when they leave for 6 months and the valve is seized, or they move it and that's when it starts leaking because it hasn't been used for a very long time. So exercising those valves regularly or inspecting them and making sure that they're not seized and leaking is also part of the shut off process. Shut off valves for the common areas. Ensure that you have a valve chart available for your on-site staff or the board so they know if there's a major leak on the O1 riser, where that shut off is for that particular riser so that they can shut off the water and stop the leak if it can't be shut off from in the suite. You can also have those marked in the ceiling. I've had buildings where the contractor goes in and underneath the ceiling tiles, they mark the different locations for the hot and cold water shutoffs. Another thing that I've seen more and more residents purchasing is water alarms. You can pick these up at local like Home Hardware or Home Depot. There's various levels of them. I see residents put them near their washing machines, under their sinks, and it's a device that when it gets wet, an alarm goes off. I think there's even ones now where they send, like there's an app and it sends an alert to your phone. And it's just another way residents feel a little more comfortable knowing that, if their washing machine hose fails and causes a flood, that water alarm may catch it sooner than if they didn't have it. The last is liability. So liability, the main responsibility and way to mitigate risk for liability is maintaining the property, ensuring that it is in a good state of maintenance and repair. This is a big thing for property managers, but also the board to be aware of. Also logging the status of that maintenance and repair. So as a property manager, you should be doing routine site inspections of the property. If you notice something like a trip hazard or a pothole or what have I seen, wooden garden edging that's come loose, it could be, something someone could trip over. Note that in a site inspection, but also ensure that it's addressed in a timely manner. Don't just note it and then not fix it. That's just going to cause you more problems, but ensure that you're addressing any maintenance and repair issues on the site to mitigate liability risk as well. That's it for me.
Wonderful. Thank you, Michelle. So those are all really great suggestions. One thing that jumps out on me is a couple of them were recommendations within the unit. So owner responsibility, let's just assume that's what the declaration says. How far can a board of directors or a manager go in insisting that an owner do something within their unit? What's the best approach that we go from there? What do you think, Richard? What kind of authority does a condo have in saying you have to put a water detection device on any of the components within the unit?
Well, if you put the owner on notice about something, perhaps that would go more towards the omission. If they don't, could raise the standard. Some requirements, smoke detectors, etc. There's law now, but the condo shares that.
Right.
Share best practices. That's. Yeah. I like the idea of communicating, sharing practices. And again, then if an owner chooses not to do it, perhaps that helps with the omission argument.
It's a tough one because technically condos don't have a right to say what happens within a unit to a certain extent. Sometimes what we've seen is if a corporation is perhaps it's an older corporation high-rise, they're prone to flooding or older piping, we work with the insurer and we get their kind of advice or opinion on what are the risks associated with an actual insurable loss happening. And then we can kind of rely on that, those provisions in the declaration that says an owner won't do anything, which might increase insurance losses, and kind of put them on notice in that sense. And I think that plays into your act or omission, Richard, is that you try to kind of gather as much information as possible to persuade them to do it on by themselves, but also to show them that, hey, maybe you have a legal obligation to actually do this.
I remember years ago coming across a board for smoke detectors for an older condo. They actually arrange to buy them in bulk to make them available to their owners. It's something thinking outside the box to actually deal with something proactively. If you've got a problem with pinhole leaks or whatnot, older condominium, then why not think about ideas where you can get the buy-in by the community?
I think communication is key, and I think a lot of times it's how you say something versus what you say. Demanding owners do something goes over not as great as, here's a suggestion, it's for everyone's best interest, and this is how we're going to help you. A question that we received my goodness, time flies, at the last part of this webinar was, should condos or can condos pass bylaws mandating owners to have insurance? What's your point on that?
Mine?
Mark, Richard?
I'm seeing that in some declarations. Some newer condos have got wording to that effect in declarations. I don't know how it's going to play out. I'm advising clients against putting it in bylaws or rules. In talking with Mark, I find out that a lot of owners can't get insurance, so that's going to be problematic. But I also see it as, how is the condo going to enforce this? If you have a bylaw, you have a provision, Section 17, Sub 3 of the Act says you've got to take all reasonable steps to affect compliance. Well, what does that mean? Like, the condo's got to do something. And I just see this as a headache that's not going to really give anything back to the community. It's in the owner's own interest to get it. But all you can do is it's that old
I believe
thing.
Yeah, and Mark, what like from the insurance perspective, does the corporation, as long as they have what they are required to have under the Act, and hopefully there's a standard unit bylaw that defines what they have to put back once there's an insurable loss, does it matter if an owner has insurance? Do you care as an insurance provider?
Well, of course I care. I'm an insurance broker. We have to be sensitive to that. But the reality of the animal is, this was brought up, and as a matter of fact, I think there was a condo out in Wentworth some years ago that actually did try to pass a bylaw saying that unit owners shall have insurance, and they had to provide a certificate. And I think for some reason, it got abolished and completely taken out, because unfortunately, unlike auto insurance in the province of Ontario, whereby the government says you have to have it, it also says insurance companies have to write it. Whereas, unfortunately, that's not the issue with condominium and unit owners insurance. Even if the board said you have to have it, there is nothing out there that says an insurance company has to write it. And as Richard said, there are people out there that simply can't get it for whatever reason. So I think it's going to be a very difficult thing to do. As to the only reason the corporation should really care about that, it does make it much easier to get back coverage for the chargeback of the deductible when a unit owner has insurance to cover it. If they don't have it, then really, you can still have ways of getting the money back. But you're right. Does it really affect the corporation? Not really, because unit owners insurance only covers contents and betterments and the cost of moving out to a hotel should they not be able to live there. And you know what? It doesn't really impact the corporation that much.
Right, and the corporation at the end of the day looks out for all the owners, not necessarily one, and the corporation's best interest in protecting its property and its assets, which are not necessarily contents of a unit. Maybe we've taken it for granted, but can someone just briefly summarize, how is the standard unit bylaw passed? Is it like any other bylaw? What's the threshold? This might be a good question for the lawyer.
It is just like any other bylaw. The bylaw describes what's going to be the base unit that the condo's insurance will cover, and it goes. The board passes it first, then it goes to the owners. You have to hold a meeting of owners, and it's passed by a majority of. The traditional way was a majority of all the units voting yes, and it has to be registered. We keep coming across old bylaws that never get registered, and those are useless. All right, because a bylaw is doesn't come into effect until it's registered.
But Richard, the intention was there. And ideally, we had a question, well, how do you get a sample standard unit bylaw or a deductible? I would say it's very hard to get a sample standard unit bylaw because it depends on your specific property. But ideally, you can work with your council to define what those standard unit features will be. And you can also include in the standard unit bylaw the insurance deductible provision. So create as a one bylaw, I'm sorry for any lawyers out there who don't like me for saying that, but you can include into just one bylaw and have that passed by owners. Sorry, Richard, do you have another comment?
No, I agree with you.
Okay, wonderful. Oh, that's always so nice to hear. So with respect to high rises and townhouses, Michelle, we had a question last week, and it's similar to what we just discussed about taking steps to be proactive. Fire alarms or smoke detectors. Do you see any difference in high rise versus townhome units requirements, aside from anything from the building code? Any recommended steps owners or boards should be taking, or is it kind of the same application irrespective of the type of building we're dealing with?
I think there is a difference. Townhouse sites, typically the corporation, the board management are not, there's not the monthly and the annual inspection and maintenance requirements, the same as that there is in a high-rise building. But I think it's still important if you're doing newsletters or any type of communication you're putting out at your townhouse site, remind owners to check their smoke detectors, remind them of their obligation to have a working smoke detector, carbon monoxide detector. I think that reminder is still there, but typically just between the difference of the types of properties, you know, we don't have a master key to townhouse sites. You know, we're not entering the units frequently for maintenance and repair. So typically that responsibility falls on the unit owner. I've worked with one site that has actually, the corporation has an in-suite security system, and so the smoke detector inspection is part of that, and that's written right into their declaration. But again, high-rise, because of the way it is, the system's interconnected with the overall fire system for the building. Typically, the corporation, not typically, always the corporation is doing the monthly and annuals. And then it varies from corporation to corporation, whether the corporation is going to cover the cost for the replacement of the detectors or whether that's a unit owner's cost to, you know, replace and maintain the equipment within their suite.
Yeah. Could I add something to that? And a big difference between the high-rises and townhouses with respect to the condo's obligation to ensure smoke detectors are there. There's an old case from around 96 or so where the condo got charged with the unit owner when the unit was found not to have a working smoke detector. And at the end of the day, the condo defended, but at the end of the day, the condo was held responsible because there's this residual obligation or residual right on the part of the condo to actually go in and do the repair or the maintenance if the corporation doesn't do it. And the court said, you know, fire doesn't respect unit boundaries. So condo, you've got that obligation to maintain, to manage the property generally. So you've got to do something. And in this particular case, the condo had taken a lot of steps to make smoke detectors available, to create awareness and whatnot, but could not show that it did anything with respect to the units in question. So in a high rise, you can do the annual or semi-annual, let's go in and push the button everywhere in every unit, make sure it works. In a townhouse, it's a little bit different because, as Michelle said, you typically don't have that ease of access. You have a right of access, but it's hard to actually exercise. So one thing you might want to do is do a reverse onus where the owners are coming back and giving you some document signed off that says, yes, I tested it, I changed the battery on X date, and everything is perfect. And that way the condo's got a record with respect to that particular unit.
It's a great suggestion.
Very good point. Richard, there's another question from last week. You kind of touched upon it earlier with respect to chargeback. The question was, how is the chargeback any different if it's a claim that started with an insurer or if it's not a claim and it's just for repairs? Is the chargeback the same process?
Is it any different?
Yeah.
No, because if it's an insurable loss, like we're talking, as long as we're talking insurable loss, then the right to charge back falls under Section 105 of the Act. So the condo can decide whether it's going to put a claim through or not. But at the end of the day, it's an insurable loss. So the maximum recovery is either it's the lesser of the deductible or the actual or the cost of repair. And Section 105 gives you the lien rights. in either case.
Right, and whether you choose to start an insurance claim and charge back the deductible or charge back the repair costs, whatever amount, they're still stuck to that lien process in the Condo Act with the 90 days registration. So it doesn't matter what you're charging back, well, to a certain extent, the process to lien remains the same.
That's right. And just to repeat the point I made earlier, don't wait till the third month. All right, there's too much money involved when we're dealing with this type of chargeback.
What do you think about if there's pushback from an owner and they say, no, I don't think I am responsible for the damage that was caused or the payment of the insurance deductible. I'm not responsible. Should the condo keep kind of fighting back with the owner, or should they register the lien and have the fight later? What should the condo do to secure its rights going forward?
First, have Michelle set up your file, so everything, all the back supporting documents are there. But if you're asking that question, ask your lawyer, to find out what you should do. Like that's really the most straightforward way. If it really is, if you're humming and hawing on what to do, if you've got a $10,000, $20,000, $50,000 deductible chargeback and you're worrying about $1,000 cost on registering the lien, get the lien registered, because at least then your position's crystallized. One of the proposed changes to the Act, which hasn't come out yet, has to do with chargebacks, where if there's going to be a dispute or a challenge to a chargeback, then the lien time will just stop running, and everybody can deal with that. It's a great idea. And it's one of the ones we still have to wait to work through the process.
But, you mean there's still more coming down the pipe?
There's more coming down the pipe, but
there's a couple more.
Yeah, don't lose your lien rights, because you can't get them back. Yeah. It's very hard. Right.
It's not worth the risk. Another question we got was, well, when I purchased my unit 5 years ago, I purchased a lot of upgrades. Should these upgrades be provided to the condo board when they're coming up with their standing unit bylaw? Will my upgrades be captured in the bylaw? It seems to be a little bit of confusion as to how many definitions are there for a standing unit bylaw. Can you have a bylaw that has Class A, Class B, Class C, or is the definition applied to all units equally?
I feel like I'm talking a lot here, but I'll keep going. The Act says you have to put in place the standard definition per class of unit. So if you've got residential and parking, to me that's two classes of unit. For the residential, typically I want to put the unit back to a livable, sellable condition. And the Act doesn't say what is a betterment or improvement. The Act doesn't say you've got to go back to how the condo was at registration to figure this out. The Act says you can pass a standard definition to determine what are betterments or improvements to the unit. So you can make it up. There's nothing, and this is, I guess, what they're doing with it when they go back to a bare bones. They're just saying where they're taking out everything. I want to put it back to a livable, sellable. So there's a lot of ways to mitigate on that definition. For the parking unit, typically a parking unit, I am going back to unit boundaries. Typically there's no reason not to do that. So two classes of unit, two definitions.
And Michelle, a question for you. From your experience as a manager who has to go out in front, well, maybe a little bit different now, owners to pass standard unit bylaws and try to tell them this is a really good idea, and to tell them how the board came up with the definition, what's your best practice? Should the board send out a draft to owners before, or should owners or the board send out a questionnaire what they'd like to see in a standard unit bylaw? What's the most successful boards do in getting a standard unit bylaw passed? Because there's always going to be pushback. Owners will say, well, I have a wooden floor. Why isn't that included? Or another will say, well, I'm not paying for the mahogany countertops. So where's that middle ground?
Yeah, it's a good question, because they're difficult to pass. If you talk to corporations that don't have them, they've tried several times, they can't pass them. Even putting the deductible provision in place is difficult to pass. You have to communicate it effectively. Otherwise, the owners just think the corporation's trying to put costs on them, essentially. So I think communication in advance, explaining the process along the way is very important, so that it's not just here's an owner's meeting package, here's a bylaw, try and figure it out and make a decision at that point. So advanced communication when the board starts that process is, I think, is important. Personally, I don't know if I would recommend polling owners to see what they would like included, because you're going to get a million answers. It's going to be very hard to please everybody. I think the board needs to work with legal counsel to determine kind of what reasonably defines the unit in that building. But communicate with owners along the way. This is coming. This is why we're doing it. Explain the pros and the cons to it. Because yes, it can be difficult. And they need to, I think, going back to, again, the importance of it and why it's in place. I typically explain kind of the community aspect of it. Do you as one resident want to be paying for someone's marble countertops, or do you know, so I try to put that perspective on it. I go back to the community aspect of it and not as one individual. That's how I try and sell it to owners, if you will.
Mm-hmm. Yeah, it's certainly a topic. I think, you know, when we were planning for this webinar, the first part of this webinar, I think we had a conference call for over an hour and a half. And then the second part, we had almost up to 2 hours. And we thought, why didn't we just videotape us talking about this topic? Because I think there's just so much to it. You know, put an insurance guy and a couple lawyers and manager in there. I think we could go all day. Thank you so much to everyone. Thank you, Mark, Michelle, and Richard, for sharing your best practices and practical solutions. And thank you to everyone who was able to join us here this afternoon. We have a couple upcoming webinars. That Owner Did What will be aired September 15th. Deals with difficult owners, going from difficult owner to an engaged owner and the board's role. Then we'll have the level 208 nights between September 14th and October 6th. After that, we will be holding the annual general meeting, our first webinar-based meeting on October 21st from 3 to 4. Registration is now open to sign up, as well as the Intro to Condominiums course, which will be held on December 3rd. And again, registration is open and everything can be registered online through our website. Please give us your feedback. We greatly appreciate it. We want to answer and provide you with webinars that are useful to you. So everything that you provide to us, we do consider and we do review. We hope you enjoyed today's Condo Talk, and we look forward to seeing you again next time. Have a good afternoon.